Good afternoon, everyone. Welcome to our December Outlook call. We've got the usual from Gary Duggan giving us an overview of where the world is or where the world isn't, or as he said last week, are we just pausing for breath? And then we have a good friend of the firm, Elliot Andrews, the CEO of Aspen Digital, formerly of Hong Kong, but now of the ADGM, and he's going to give us the reason where the digital economy isn't, and maybe a little bit of look of what we have with stablecoin. Gary, I'll hand it over to you. So last week you said this was a pause for breath. And then we hear the Bank of Japan might do a rate hike. We have physical payrolls are down. What's going on, Gary? Give us an overview, please.
Yeah, so we just got in the can, should I say, the 2026 outlook, and I'm still not sure what to call it. So let me try and give you some perspective with a few slides.
Can we have a competition for everybody to put in a name for the outlook at the end of the call?
Let's see if we
Go
can.
Go ahead, Gary.
Yeah, let me just. I can just get this up. So.
Okay, while Gary's going through that, if you have any questions, usual format, leave them in the chat box. We'll deal with them at the end. Gary, here we go.
Yeah, is it coming up?
Yes.
It's not.
Yes.
Oh, here we go. Yeah, got it. All right. Yeah, so I just called it a macro market perspective for today. But let me just go. Let me just get into a little bit of the history of just the last year. You know, when we reflect on, I suppose if you were to tell someone what was going to happen this year at the beginning of the year, they probably wouldn't have invested a dime. And they would have missed out on the kind of returns you see on the screen here that year to date, you know, the equity's up around 20%, although that's been a good measure of the emerging markets, up 27.7. But even the US, with all of its challenges of geopolitics and changed leadership in the White House, up above 15%. So I say that there's got to be a logic or a madness, a logic in the madness of markets. But by and large, you know, this year we still had interest rates falling, and that's been a very key element of I'll call a repricing of assets. So bonds have been relatively quiet. You see the global bond index of around 5%, which those are the high quality bonds, which have typically just clipped their coupons at a bit more. And high yield bonds, which have not quite been the asset class that many people had suggested, which that they're equity like. Well, yes, they're equity, but only at 50% of equity this year with a return of 9.4. But you know, the store of trouble still for the world is the number for gold. It is such a big return for the year. It is telling you something. You can't just dismiss it as an imbalance between supply and demand. Of course, of which this is, but you know, it's not just technical. It is a deep-rooted fear, I think, in the economy about trouble ahead. But in the meantime, people are equally prepared to kind of run the beta of the markets, which is the allocation to equities with the kind of returns that we've seen. So let's just go forward and then put some meat on the bones. So as we think about 2026, I think I'd be very surprised, but not completely surprised, but I'd be very surprised if we were to see the same kind of returns in 2026. And I think you have to say that there's a building left tail risk. So by that, I mean a building risk of downside, not upside, considering this is relatively late cycle. And there are a lot of geopolitical problems building, and there are problems that are not solved, and there are problems that are structural. So, you know, in terms of the positives, I would say there's a good measure of confidence about still good growth, but not great growth. There's still going to be some rate cuts, but they're going to be relatively modest. And I think, again, we're going to see that there's a greater focus on the East rather than the West. So Asian growth, which will be stronger and where markets are cheaper, again, I believe will be in focus. Now, inflation has been well behaved outside of the United States. And you would say in the US so far, it's been okay, no drama, but it still is a level which kind of starts to limit the degree to which the Fed can cut interest rates. And I'll come on to that. And in the rest of the world, you know, if we still have growth bubbling, it is going to create some kind of inflation pressure at some stage. And I think obviously Japan in particular has got an inflation problem, although it's a good problem. And I think we're going to see increase in interest rates there. The last point I'm going to focus on is geopolitics and technology. I just think the thing that is going to create more problems for geopolitics will be worsening labor markets, and there are some signs of that. And I think tech is a potential productivity tool, but also a disruptor to those labor markets in the future. So with those headlines, I'm going to go quite quickly through some pictures because some of them you've seen before. This is just a screenshot of Bloomberg. Two things I want to get across here is that when we go to the top line, you're seeing only relatively modest G8, the biggest countries in the world, developed countries of the world, with the growth rates which are only touching 1.5, maximum 1.7% as we go through the next 2 or 3 years. So we have seen the best of the recovery from COVID. We've seen the best of the big fiscal explosion of spending that went on from governments. And we're probably seeing the best of the consumer because of the squeeze on income. So we are now into what I would call more mature. But for those people who have been looking at, like I have, these markets for some time, you're going, really? Is that all we're going to get? 1.5? That is the trend growth of the global economy going forward outside of the emerging world. And I think the good news is that we've got an emerging world that's growing and will become more powerful and bigger in the global economy, but we're talking about 1.5% growth. The second important point to take away is the one black line there on its own, which is US inflation forecasts out to 2027. The idea that the Fed could just keep it cutting interest rates to help, it does not play out well with this kind of these data points, which are saying that inflation will be a problem, i.e. we will have US inflation at the upper end of a flexible zone that the Fed might feel comfortable with. But I think when it's still touching, the forecast is still touching towards 3%, that will limit the degree to which the Fed can step in and cut interest rates as we go through the next 12 months. So the good news is on this page, because top line, and we don't need to go through the detail, but many countries here in the East contributing to growth. And that gets us to the 4 to 5% level, multiples of what G8 is producing. Now, of course, companies in the US equity market do have that overseas exposure and can enjoy some of this. But you would say, I'm just going to go to where I can find that growth at a cheaper price, which we believe will be in Asia, and that would still be an overweight in our portfolios. On interest rates, this is a detailed picture of the future. The red bars on the right-hand side just show you where to pick up the line. So you can see a big red bar, which if you read across is Brazil, and the one at the right at the top there is the US. So these are countries where in the next 12 months, we expect a cut in interest rates. Elsewhere, you can see very, very modest numbers, whether it's up or down. The only standout would be the increase in interest rates that we're expecting in Japan. So I would say that the story of the last couple of years has been about interest rate cuts of some significance. As we go forward, they're going to be more limited. I think there's a question mark over how much the Fed can cut interest rates by. There may be a little bit more cutting in Europe as we go through the next 12 months. But the story of a global economy stimulated by cuts in interest rates and markets which played off the back of that is yesterday's story, not the future story. And, even the Fed, it's not just a slam dunk that they should cut interest rates by 100 basis points. The point I'm making with this picture is that US inflation has come down, but it's gone back up again, and it's still at 3 and likely to remain at those kind of levels for much of the coming 12 months. Secondly, and this is very debatable, I grant you, but it's not clear, absolutely crystal clear, that the labor market is markedly deteriorating such that the Fed needs to cut interest rates aggressively. Now, I'm choosing my words carefully. We already have nominal interest rates in the US, which are low by historical standards. And yet the last data point from the non-farm payroll was 100,000 jobs created in 1 month. Data's a bit out of date. Other surveys have shown a little bit of weakness for sure. But what I'd say is that we shouldn't be simply assuming 100 basis points off rates in the next 12 months. That would presuppose a significant slowdown in the US economy and a Fed that has to react to that, because I believe the inflation problem is not going to go away particularly quickly. The one thing you've got to keep an eye on for 2026 is the 10-year bond yield in the US. The top left picture is the steepness of the yield curve, and this is what we're most concerned about. So whilst short-term interest rates can come down, aligned with the Fed policy, we think long-term interest rates could go higher. Now, we've stood still for the best part of the last 6 months. If you go back in history, there's a much longer dated picture there, and you can just see that we're about halfway up between a range at the bottom and the top. I'm just worried that even if the Fed were to cut by, say, 50 basis points, that the 10-year yield could be going up 50 basis points or more because of the continuing inflation problem. But also, it's this picture that's the most worrying. The blue line is the level of government indebtedness in the US relative to GDP. And we are on our way to 135%. And we can't solve that at the moment with an economy that's only growing or likely to be growing at around 1 to 1.5%, and inflation, which is at relatively low levels compared with long-term history. So the orange line, going back to the 1980s or 1960s, should I say, the orange line is nominal growth. Now, the reason that's important is if we have lots of nominal growth, so that's real growth plus inflation, that gives the government lots of tax revenues. But you can see that the nominal growth now for the US economy is kind of 2 to 3% and unlikely to be rising. And yet we have the mother of all indebtedness in the US economy. They're not going to be able to raise revenues from taxation sufficiently to bring this under control. The only way they can do it is to bring this under control by cutting in spending. And you can see we've already had a government shutdown over that. And you've obviously got people at the top of the tree in the United States who want to be very populist. And therefore, I don't believe this is going to get addressed. So this is the biggest problem for the valuation of asset classes, and particularly equities, but of course, downside to bonds if yields were to rise. But nothing in that picture at the moment gives me a warm feeling about 2026. So as we go into 2020, we do believe that global leadership continues to evolve away from the US and to places like China and India, which are a very significant part of global GDP these days, but obviously equity markets, bond markets, which are relatively underdeveloped. But I can see both in China and India reasons to believe double-digit returns in the next 12 months. I'll come on to things just to speed things along a little bit here, just to what I worry about most, and it's this picture, that we're going to get Western governments under a lot of pressure to run loose policies and therefore doing damage to their bond markets, but also doing damage, or we will see initially damage to the equity market because of slower than anticipated growth. This picture here is the S&P 500, which just keeps striking higher. And then the other line is the dotted line is for the number of jobs being created. And I could take this back over an extended period of time. We have never had such a big gap between the equity market and the employment market. This is leaving people behind. As we get more unemployment, we're going to get more protests. As we get more protests, we get governments that either cave and become very populist or actually have to address the problem. It's like thinking about Trump versus Thatcher. Thatcher did it. She did a retrenchment of the economy. More people got unemployed, but people bought into it because they believed that the economy needed it. I'm not so sure people are minded like that anymore. So unemployment will be the Achilles heel of this market. It'll bring populist policies, which will unwind a lot of the good work that's been done over 20 years in bringing inflation down and having low bond yields. And just to give you some sense of the building problem, and I won't go through all the AI questions here as well, but people can see that already happening. But in the US, graduates account for 25% of all unemployed. and 30% already of long-term unemployed. It's not as if it's just started. This has been underway and building. In India, they have a challenge at 45% youth unemployment. So even with the growth they've got, it's about bringing to bear the right skills on the labor market and making them fit for purpose. And as we look to further extend it, in Africa, which will generate 1 billion people. So we think we have an immigration issue today. Can you imagine if people are not able to find jobs in Africa, where they might be traveling to? So, and we already know youth unemployment is clearly a big challenge in China. So this, to me, again, I'll go back to it. If we think about one developing theme through 2026, it could be of increasing unemployment, bringing about kind of maverick populist policies that undermine the bond market and hurt the markets. So when I think about asset allocation and portfolio themes as we build out for 2026, we still play the theme that the markets will start on a good footing, a relatively good growth, some interest rate cuts coming, particularly from the Fed. That'll keep people engaged, but we are worried about longer term debt and yield curve steepening, and therefore we remain short duration. We're not giving up on technology, and I'll come on to that in a second. And we have a bias in our portfolios for the East over the West. So that means underweighting the US market and overweighting the likes of the Japans and Chinas, and increasing our allocations to commodities. So a few pictures to explain that. Why is the NASDAQ not so bad? I thought I'd never say it because I had always worried about some kind of correction. But the orange line there is the level of expected corporate profits for the NASDAQ companies, and the blue line is price. So that, when people talk about overvaluation, I mean, it doesn't really ring that true, because Nvidia is on a PE in the 20s, not in the 50s. Your average stock in the NASDAQ over the last 12 months has seen its PE multiple fall, not rise. So why pick on it now? Particularly as we're seeing now the big build out of data centers and all the enthusiasm. That doesn't mean I'm a raging bull. It's just that I would keep it in my portfolio at this stage. One of the problems, though, is that when things go wrong, they go badly wrong. So there was a lot of stories about Oracle, which is the blue line you see there, how great it was. And Oracle sat in the middle of this ecosystem of companies announcing that they had a big order from someone, and that went great. I've got all the sales I need in the future. But there isn't the money to keep this thing going. So people are ordering things without actually having the capital at hand in order to fulfill the order, or in order to be able to put up the money for the invoice. So this is an ecosystem that's going to need funding. If it doesn't get the funding, and a lot of it's becoming from the private sector and not the public markets, then we could start to see trouble. And equally, if companies do disappoint, you get some downside. So the way I think about that is that it's not necessarily bad news for the whole sector. It means that there are winners and losers. And this is an interesting one. The winners and losers are shown here with Nvidia versus Google. We had typically had everything that was highly correlated before, always going up together. More recently, that's broken down. But that's giving a great opportunity for tech funds. And there's one here, which is Polar Capital, where you can see that up until the middle of this year, it was kind of barely beating the index. And then as we went into the latter stages of this year, where people were more discerning in the sector, we've seen some significant outperformance from stock picking. So it's not about ETF exposure here. It's about active management. And one of the last themes I want to touch on is commodities. We still see a lot of upside for precious metals. If I think about allocations within portfolios, doesn't matter how many times people tell people their allocations to precious metals are low. In the United States, typically 2 to 3% max, if anything at all, because people have been in love with the S&P 500. I think that will change. And it's already changing in the rest of the world. And then secondly is, and this is a picture of copper. Copper, you will read this morning, is at an all-time high. But you look at copper and you go, well, it's gone nowhere for a decade. So don't tell me this is an expensive metal at the moment. It's just that it went down a long way and went back up a long way. But I do think with the other angle on the technology story of course, is the need for rare earths and strategic metals such as copper. So I see more upside there, and I would build my commodity exposure more from, say, 3 to 5 up to 5 to 7% for 2026. So in summary, consolidating growth, yes. We've still got growth, yes. Risk of recession kind of marginal at the moment, but it is at lower levels, so not as great as we had this year. East beats West, the emerging markets beat developed markets, and in the emerging markets, governments have got more scope to use fiscal policies to support growth, as most of their balance sheets in the emerging world are in still good shape, which is good news for emerging market debt as well. The other question would be on the technology sector. Yes, it's volatile, but I would still stick with it, but more of a neutral view than in the past. And on commodities, very much in demand and part of our strategy. So equity strategy, underweight the US, neutral on Europe, although I'm worried at the moment with the stories coming out of Germany about a lot of problems there at the moment, which could end up being political problems that cause a greater problem for Europe, but that I think could be offset with further cuts in interest rates from the ECB. The point I want to make most substantially, though, is that the last 10 years has been all about ETFs, but in Europe, a good active fund this year could have added 300 or 400 basis points to the index return. In China, there are funds out there, I think I mentioned it before, that have beaten the benchmark by, in a sense, twice the index for the same risk. In India, again, typically managers are beating the indices. In tech, active management. In commodities, you now find managers actively choosing the right stocks to outperform the underlying commodities. So I would say one important theme for 2026 is think active before you think passive, whereas in the past it was why do I have anything other than passive in my portfolio? This is going to be an active world and it needs stock picking skills. And in bond strategy, it's short duration, particularly in dollar. Take care on high yield. It has performed very well. And I think it just gets more challenging when yields are so low and spreads are so narrow. And emerging market debt still has room to perform. And again, back to active management, strategic bond funds can beat your kind of dull, boring ETFs that just buy the US 10-year. You can do better than that with some very good managers. And just to finish, let's not forget, in the background, we've still not solved Ukraine. If Venezuela blows up, that could create even more problems for the oil price and for other matters as to what do the Americans do next. And in the background, I think China's really starting to up the ante around a discussion about what's going to happen with Taiwan in the future. And they've clearly got a strong view on that. But what I'm saying is these things shouldn't be forgotten because these are the things that come back and bite you. So not to take inordinate risk. And particularly as in the West, we still have rising deficits that have not been taken seriously enough by governments, which will have to cut back. As they cut back, it's more taxes. And if people are being taxed and they're being made unemployed, then you can expect much more populist noise in the future, which may impinge on the returns on markets. So, as I said, I sit here waiting for some sage to tell me what to call all of this. But as we look into 2026, I would just say it's more complicated.
Thank you, Gary. I've got a few questions that have come in that I'll deal with later. I guess, this is probably our last call for 2026. I was hoping you'd have something nice that you could leave under the tree. But it feels like you've left us a hand grenade that's probably going to go off. Okay, we'll come back to that. Next guest is Elliot. Elliot, how are you? Elliot's based in his office there in the ADGM, formerly Hong Kong. How are you, mate?
I'm good. I'm disappointed Gary didn't mention crypto once.
Yes, well, you guys had lunch last Tuesday. I think he was trying not to mention crypto. So maybe you could do me a favor and maybe just give a brief intro on Aspen Digital, and then tell us how you think the world's gone, basically from a digital assets point of view, and what do you think is happening for 2026?
Perfect. Let me share my screen. You can see this one, okay? Good.
Yes, it's coming
Perfect.
on now.
So just a quick overview on what we do. We built our platform in 2021 to service private wealth coming into crypto. Obviously, it's a pretty new world for a lot of people, and there's a lot of differentiation between sort of traditional allocation and crypto. And so we wanted to consolidate all the different products that you might want to access to build a crypto portfolio. So we cover trading, we have yield products, both on crypto assets directly and some US dollar ones. We do venture allocation in the fund side as well as hedge funds. We do some direct deals into crypto names and some tech names. And then we obviously have the custody platform as well. And as Dave mentioned, that's all under a licensed framework, which is ADGM now. We service about 300 clients globally, ex-US, majority sit in Asia and in Hong Kong. And so we're in Abu Dhabi now. So if you're ever here, please look me up. I pulled a few slides just from a family office presentation we did here in Dubai a month ago that I think are most interesting, just to sort of put a lot of what's going on in context. Obviously, it's been a pretty wild year for crypto in general, and we're kind of flat on the year on Bitcoin, and all the other ones have performed pretty poorly. But I think it's really important to zoom out and understand where we are now. We're in a much better place than we've ever been before, and a lot of the institutional adoption is just starting. And one of the main questions I always get is like, how much should I allocate? I think it's changed from should I allocate to how much. And so we always tell people to think of the global portfolio of everything. And this slide has been stolen from our friend Michael Saylor's deck, but Bitcoin's a 2 trillion asset class. As of today, the whole crypto market's about 3.2. So it's about a 0.3% of the global portfolio. So that's where I try and get clients to think. And it's a pretty easy stepping stone. And I'll explain a little bit why that has material impact on your overall portfolio later. Thankfully, this kind of complements what Gary's saying. There's a nice orange line almost every year since genesis of Bitcoin, where it's been one of the best performing asset classes globally. Obviously, this year, this is at the end of September, and so we've come down a bit from there, but gold's had a blockbuster year, emerging market equities, and then developed. And Bitcoin's, as I said, probably come down from about 120 here down to 95. But historically, it has been the best performing asset class, and it's my belief that it will continue to be a very high performing one based on what we're seeing in terms of new inflows coming and where they're coming from. This is always an important chart because it helps people frame how early we are, just in terms of adoption. I mean, you've got over 500 million users of crypto now, and you just put that in perspective of where we were when the internet was just getting started. And a lot of crypto firms will put this chart in front of you, but it's just showing you how quickly this can scale. This is particularly scaling in emerging markets in terms of number of users through things like stablecoin and the unbanked. But it is growing exponentially. And a lot of that is because of the new subsectors that have emerged. Obviously, we started with Bitcoin in 2009 as a peer-to-peer currency. Then you had Ethereum come through, which enabled you to program the blockchain through smart contracts. And then you had all this other stuff come. Privacy is now a big narrative. People don't want everyone knowing what they're doing because obviously blockchains by nature are transparent. You've got stable coins, which have had explosive growth this year. Then you had DeFi emerge because you had smart contracts and you had stable coins. And then you had all this gaming and metaverse, which was a bit of a bubble. That's really struggled since 2022 and doesn't show many signs of coming back. And so the real focus for us has really been about financial services and how blockchain can make that a better product. The other big narrative that's been huge at the moment is prediction markets. You've probably heard of Polymarket, Kalshi. There's a few others that are popping out. Coinbase is going to be launching them soon. And so that's using blockchain technology as an underlying. The users of that do not know that blockchain is there. So I think that's an important thing to think about is some of these new subsectors emerge is what is the product and why does it make the old way of doing things better. Just talking about 2024, obviously the launch of the ETF was a huge moment for the asset class. I think that was the one moment that really made it an institutional product. And it took a long time to get there. But launch, obviously, we launched just under 50,000, had an all-time high last year of 1,008, thanks to our friends in the US. But there's been some really important developments over the last couple of days as well, because, I mean, obviously, BlackRock's been in for a while, but Vanguard was basically the last one to cave. They were always publicly very against Bitcoin. And this is why we've seen a bit of a run up in the last 3 or 4 days, as Vanguard's now going to start offering it as part of their platform through ETFs. And then Bank of America came out yesterday and saying they'll allow their managers to, or their advisors to, put up to 4% of the portfolio on Bitcoin. Just in terms of the ETF adoption and how it's gone, year 2 is just Q3, to the end of Q3. But just comparing it to gold inflows when that launched, you can see it. I mean, it's just massive compared to how gold was. So the appetite for this at the institutional level has been huge, and it hasn't really showed signs of slowing down. You've got more and more people pouring into the asset class, thinking it warrants some sort of allocation. It's just really figuring out what that number looks like. And here's just some of the institutions that have launched either funds, custody, trading, ETPs, doing payments or tokenization. I mean, every traditional financial institution is scrambling now to think about what their crypto or blockchain strategy is, and what do they want to offer clients, because there's demand. Then just on the stablecoin landscape, 2019 we had $2 billion worth. Now it's actually over 300 billion. This has just been an explosion due to being the killer use case really for blockchain, right? You can move money freely anywhere in the world. All you need is a wallet. You don't need a bank account. The on and off ramps are still difficult, and that's one of the big frustrations that clients have, is it's not seamless to get your money from your bank account into buying stable coins and the crypto ecosystem. But this is just growing exponentially at the moment. And if you look on the right, it's really dominated by 2 names. You've got Tether, which is sort of ex-US, and then you've got Circle, which is inside the US and regulated there, and obviously listed earlier this year. And then the other category is mainly US dollar still. There's some non-US dollar stable coins that are emerging. I mean, Hong Kong's doing some pilots at the moment around that. It hasn't really taken off. And people are pretty happy to be in US dollar denominated, because all of your trading pairs generally are in US dollars. Tether is a very interesting company on its own, and it kind of highlights how profitable some of these blockchain first companies can be. I mean, they have very little employees. They'll probably make $15 billion in their profit this year, 90% profit margins. They may, as you can see on the right-hand side, their revenue per employee is astronomical. It's $85 million. They're now the 17th largest holder of US treasuries. So they're actually becoming pretty strategic for the US government now. And so there's always talk about them getting banned and what they hold to back their stable coins. And they released an attestation report the other day. And so there's been a bit of discussion around that, because they do hold some Bitcoin and gold backing that, which obviously isn't one-to-one. But predominantly it is US treasuries. The big difference between Tether and Circle is obligated to only hold treasuries. So obviously highly liquid product. Just talking about payments is the primary use case, but now stablecoins have overtaken Visa in terms of number of transactions. It's in the trillions. As you can see, 2024 was the breakout year. Halfway through the year, we're almost at 2024 levels. And this is really just because it's extremely easy and a better, faster, and cheaper product, right? And there's always different applications you can use inside the crypto world, but really moving money around the world, as illustrated on this slide, you look at what the existing infrastructure looks like, and the number of intermediaries and counterparties that sit in between you sending money and someone receiving it, and the time that it takes. It just shows, as you can see down the bottom, like it costs nothing and it's an instant. And so this is really coming through in applications now. There's a lot of credit cards that are attached to stablecoin rails. that have emerged, and so they're sort of doing extremely well. They're doing a lot in payments. They're generating real revenue as a protocol, and there's tokens attached to that. But this has just been one of the main reasons you're seeing wide-scale adoption of these stablecoins. Then the other big theme for this year has been the tokenization element, and that really is just bringing traditional product onto the blockchain. The main one that has been treasuries, so short dated paper, where you can essentially buy it with stable coins. You can hold it, then you can come out of it, you can trade, you can do all these different things. You can access private credit. Stocks are starting to come on chain as well, which means you instantly settle and it's 24/7 trading. And then you're seeing some funds come on as well. And like obviously you get some more liquidity. I think in the stocks case that's not true at the moment. Obviously when stock markets aren't operational in the traditional world, there needs to be some sort of pricing mechanism, which isn't working that well, but eventually it will get there. The operational efficiency piece is huge, particularly when it comes to funds. Essentially, you can put product on the blockchain and remove a lot of the intermediaries and the time that it takes to launch a fund. And then one of the other pieces is democratize access, right? You can start to approach a whole new investor base because you can basically divide up the size of these investments. So in Dubai, for example, they just tokenized a building. They sold it out in like 5 minutes at $100 a piece. So people can get exposure to real estate without actually having to buy the whole property. Then just onto sort of allocation strategies and just having a look at, this is a traditional 60/40 portfolio with a little piece of Bitcoin and what that impact has been over the last 5 years. So this data is from 2021 in terms of overall portfolio performance and then also drawdown, right? Obviously, it's hugely volatile, and so drawdown will increase, but what we really care about is that Sharpe ratio. So your risk-adjusted returns are going up as you're putting more Bitcoin in. And look, I think the other important piece is zooming out, right? I think people in this asset class get really stuck on short-term time horizons. But if you look at it over any time horizon over sort of 2 or 3 years, you're going to have made money and it's going to have a meaningful impact on your portfolio despite having pretty minimal size in terms of allocation. Then just talking about the kinds of vehicles you can access this through. You've obviously got your tokens, so buying Bitcoin directly. The ETFs probably fall into that bucket. Down the bottom, we've just put sort of what they're analogous to in terms of the traditional product. You have a lot of market neutral funds as well. So these are non-directional hedge funds that are trading inefficiencies in the market or providing liquidity into decentralized finance. Typically 1 to 12-month lockups. You'll see a good fund this year will do anywhere from sort of 15% net of fees to 20% with no drawdown. But the idea around these is in a good year, you're doing 20 plus, and in a bad year, you shouldn't be losing money. Then you've got your liquid token funds. These are hedge funds, sort of active managers on the discretionary side. They've had a terrible year. You shouldn't be paying anyone to buy Bitcoin for you, so they have to go out the risk curve. The altcoin market has been battered this year, and that's predominantly where these guys play. The quant strategies have done okay, but in terms of sort of your discretionary managers, it's been a really, really difficult year. And then you've got your venture capital. So these are investing in pre-seed, seed, Series A, new technologies that are emerging. In the family office world that we speak to, this is pretty important because obviously you're not exposed to monthly reports and the volatility that comes around them, and also it forces you to think longer term. So if you're bullish on this asset class and this technology in general, then it's a good way to allocate. And the hardest thing is just picking managers, right? We've reviewed over 1,000 managers across hedge funds and venture funds, and there's so much dispersion in returns and operational due diligence. It takes a long time to find good ones. And I know of those 1,000, there's probably 50 that you would think about allocating to. Finally, I just want to talk about benchmarks. This is something just sort of alludes back to the hedge fund piece that I was talking about. Obviously, you're probably familiar with the traditional indices, but in crypto we have the same. They're all slightly different. So you have the CoinDesk 20, which is Bitcoin at 30%, and then max weighting of 20% for all others of the top 20. You have the equal weighted 100, so that's equal weighting for the top 100 tokens. CCI 30s, just market cap weighted top 30, and then obviously Bitcoin. And what you can see here, particularly this year, is everyone has underperformed Bitcoin. And if you bought anything else, it's highly likely that you've underperformed. And this, for the discretionary managers, is what's been a big problem for them. And what people struggle with is why should I pay 2 and 20 to underperform the beta of the market, which, whether you like it or not, it is Bitcoin. And so something to be mindful of if you're ever reviewing a hedge fund deck. In the crypto space, they will have all sorts of different metrics and things that they'll put as a benchmark, but the one you should be really focused on is Bitcoin. And if they're underperforming that, just asking the questions why. Sorry, one more slide. Dollar cost averaging has historically been the simplest and easiest way to build a position. This is just illustrating if you, since 2022, so buying at the peak of the last cycle, you put $500 a month for 36 months for a total sum of 18,000 versus lumping it in at the top, you would have significantly outperformed. And this is a very common way that clients will build a position. They'll just pick a number that they want to put in there, smooths out your buying price and the volatility to an extent. And it's just an easy way to do it. So I think the main takeaway is get off zero in terms of your allocation and just be fairly simple to start with.
Very good, Elliot. Very good. Is it a crypto or is it a blockchain strategy? I like your comment that it's basically the old ways of doing things are clunky and the new ways quicker. Gary, there was a lot of old way CIO skirming about there on some of those slides, particularly around the Sharpe ratio and a few other things. I can't help but say you seem to be writing notes of questions or discussion points. I know you guys had a lively lunch last week. Do you want to elaborate as you see things based on what Elliot said?
Yeah, no, listen, I'm enthusiastic about this as an asset class. But I think people have just got to be a bit more forgiving. It is still early days, and when you see these periods of volatility, as I think there's too many skittish people who just jump away from it. I am noticing that people who have been entrenched naysayers because they didn't understand it, they couldn't understand what crypto was, and still can't get their heads around it, are kind of giving up on that because they're starting to feel very marginalized as not understanding it. So I think there's two things which are important to me. One is I think people are recognizing that it's just not a toy. This is a legitimate asset class that has a meaning in the global economy. And secondly, as Elliot's very useful data shows, this is in the mainstream now. This is not just something that is something you could have. It's something you have to have a positive view on. Timing it, all these kind of things, it's something different, but it's definitely something which is in the mainstream of asset allocation now.
But Elliot, I see it as something a little bit different. I don't think this is, the whole world is shifting. This is a technology play. Your chart on remittances and payments. Stablecoin 0.01 cent at a second. I'm aware of large shipping companies that pay port authorities by stablecoin because it's just quicker and then they can enter the port and time is money. And then off the back of that, you have a digital asset, it's Bitcoin, and then you have a whole financial system of trading and investing, and it just makes sense and ease of platform to jump across. I think, the next thing I wonder is the next real issue going to come down to tokenizing your ID? Because then, with any sort of financial sector, it's always been about fraud. And is tokenizing your ID going to be the next issue?
Yeah, look, KYC's always been a hot topic in crypto because it's supposed to be permissionless and anonymous originally. And
it was for buying drugs and guns on the platform. Why?
But the problem everyone has is you have to get into it somewhere, right? And usually that's through a regulated platform or some sort of platform that's going to take your data, and it's traceable, so they can trace it all back. Look, these worlds are colliding at the moment, the traditional and the digital, and there's technology being developed which can prove that who you say you are, without actually disclosing info. And that's kind of the middle ground that people are working towards. It's called zero knowledge proof. For this to continually get institutionalized, KYC is just, without that, it's a non-starter, right? And I think once people realize you can track the blockchain everywhere you go, it gets actually very hard to use for illicit purposes and fraud.
So, I mean, Gary, any comment on that? I mean, Elliot says it's colliding. Do you see them merging?
Oh, I do. I mean, honestly, if you look at a Bloomberg screen, you feel like you're living in the past, right? 5 by 5, 10 by 10. I mean, all this stuff is just going to go onto a technology that means we can do things instantaneously rather than having to wait for settlement and all sorts of stuff that just slows the whole pace at which the markets are discounting news. So, no, I agree with you. In fact, Dave, you made a very good point after my point, which is the technology is perhaps as important, if not more important, in terms of its impact on the way in which financial markets work. You know, how we invest in it is a kind of a sideshow. It should be about how much is this technology going to change the financial services industry?
And I wonder, you talk about the debt, and there's two things going on with the US dollar. We got a growing debt and we have a soft dollar. So surely stablecoin in USD backed stablecoins got to help the soft dollar, and probably also that extra issuing with the Genius Act and that extra issuing of treasuries has got to help the debt piece as well, or at least kick it down the road a lot further.
Maybe, but I don't know. I just think that if something it looks so bad, whether or not it's in a new technology form, it's still a bad asset. I'm not so confident. It may be a stave execution measured by months rather than years. That's my point.
Yeah, but the bad asset is the US dollar, not the stable coin.
It's not, yeah, true. But do we have to have that dollar sign on it? And we laugh about the dirham, and what was a dirham trying to say by this new funky D with 2 lines through it in a different direction to the dollar? I mean, it's something subliminal.
Elliot, what are your thoughts? I mean, what you've seen with Hong Kong. I mean, you lived here, you moved from here to the ADGM due to regulatory issues and its scalability. Where are you in relation to, say, the US dollar stable coin and then non-backed US dollar stable coins?
Yeah, look, it's just been so minimal in terms of the integration into the global system, right? Everyone still uses the dollar as their kind of unit of account when it comes to crypto. And particularly when you've got markets even like the dirham or Hong Kong, which are pegged to the dollar anyway, I see it as kind of limited value, and it's obviously only going to be used locally. I guess the one worry is you've got 2 behemoths that dictate the stablecoin ecosystem, and theoretically they can shut these off at any time they want, right? And so you're going to need some sort of insurance against that, and so that's why you see local jurisdictions trying to come up with their own, because Circle is under the jurisdiction of the US government, right? And if you're holding stablecoin and you do something with it, they can theoretically lock your funds down, and that's just, we saw what happened with Russia. Like, you can't be cut off from there, and that's kind of against the ethos of crypto anyway. But the reality is there's 2 big entities that pose a pretty big systemic risk, and which is why you're seeing a lot of narrative around Tether at the moment, because they've seen the reports, and what they've got in there backing those stable coins is not one-to-one treasuries, right? So if everyone redeemed today, they would have a real issue. The thing is, it's so big that they can manage redemptions pretty well. And they make a lot of money, right? Like, Tether is a money printing machine. I think you've also got with stable coins this concept of yield as well. So Tether and Circle take all the yield. That's their business model, right? You take your dollar, buy some treasuries, give you a stable coin, and take the split. And so you're seeing a lot of talk around yield bearing stable coins and giving the owners of that some access to it. And I think it's going to be something that gets more and more popular. I don't think everyone's going to let these 2 entities just continue to hold on to it. And so Tether's diversified their business. They have mining rigs. They do a bunch of other stuff. Circle is going to really struggle in terms of this interest rate environment. If interest rates come down, their profitability goes down massively, right? And so that'll be interesting to watch. And if you look at Circle's IPO and how it performed after that, it was trading at like 300 times earnings. It's come way back down now to probably something a bit more sensible, but that space is getting really competitive because not everyone wants to give up that, I guess, that control. So JP Morgan's launching their own one. PayPal's got their own one. Like it's the moat around launching a stablecoin is very small. And so you're going to see a lot more competition come for that business because it's so profitable.
Gary, did you want to say something, or could I?
No.
Okay, so one of the questions that came through for you, Gary, which I think is, I'm going to ask both of you. Gary, you said that you've moved from west to east as where you're lucky, and I guess the side of the question I'd ask you is, okay, from your traditional investing, you've moved from west from east. Where does the UAE sit in the middle of that? And then I guess I'll flip the question back to you, Elliot. How does your view look from west to east on a digital assets point of view? So Gary, just from your point of view, where does the Middle East sit within that view of east to west?
Yeah, and 5 years ago, the center of the global economy was, an academic said, was actually Abu Dhabi. It was that fixed point. And I would say that, in the past, it was somewhere where things came in and out of. But today, it's a major capital center of the world. It may not be a major financial sector place, although it is growing, but it's certainly the place where people come and kowtow and ask for ask for a few dollars, and that will continue. The only challenge to that, of course, is if the oil price collapses because we get a big surplus, and then these parts of the world will be spending it quickly. But I do believe it's got a place. It's a place to meet and do business. And as we look into the next couple of years, I think that it's where East meets West, very convenient, a rule of law, and capital that's here. Whereas in other parts of the world, there isn't such a big foundation of capital to kind of make sure that business gets done. It's just a place where people meet. So we look at growth rates of 3 to 6% in this region per annum for the next 3 years.
Okay. Elliot, your asset class, what are your thoughts?
Yeah, look, the US still dominates the headlines for crypto and drives everything. And unfortunately, our destinies at the moment seem pretty tied to the current administration. And look, Abu Dhabi is a very neutral ground. I think they, as Gary rightly mentioned, they don't have a huge financial services system in place. It's not like this legacy system that Hong Kong or London or New York have got. And so the regulators here have been so active in the space because this is something new, right? And they can lead in that. And I think the reason we chose Abu Dhabi, and we looked at Dubai as well, and I kind of put them in similar buckets, is they've just been so forward thinking in terms of how they want to regulate digital assets, and they've been faster, right? I think that is kind of the key in this asset class. You want to be reputable enough so you're not some random jurisdiction in some island. But you also want to be able to move quick enough to adapt to this new asset class, right? And there's so many things that come through. And look, I'm always frustrated. I want things to move faster, but there's a balance there, right? And I think the UAE has found the best balance, but they've also not had to worry so much about historical or current regulations or anything because it's relatively new, right? Like Hong Kong, for example, has got a huge financial services system. So they need to take that and see how crypto can fit into it, where Abu Dhabi isn't necessarily the same.
Gary, I had one more question before we wrap it up. And I guess, inflation-linked bonds. I mean, what are your thoughts?
I think it's a useful hedge. I mean, if you look out for the next 12 months, you'd say that inflation is anticipated globally to be drifting down, not up, because we've got lower oil prices than we had at the beginning of the year, and all of that will be playing out with lower inflation data. But I still think that the risk is of a spike in inflation. The risk is that we get some populist policies that give us another burst of growth, and we're not supplying it sufficiently or efficiently at the moment, and therefore inflation rates that go up, something that's captured by an inflation-linked bond, as opposed to sitting there on a conventional bond, which will be suffering losses from higher long-term interest rates.
Before you go, one last question for both of you, as it's the last one for the year. Elliot, what is your wish for 2026 for digital assets?
I mean, I told everyone Bitcoin would be 200,000 by the end of this year. So I've got a few more weeks, but I don't think we're getting there. Look, I think ultimately we're starting to get into the traditional space as well, right? Like we're bringing some of those RWAs into our platform, and so I hope that adoption continues. And this is why I talked a bit about that collision course. Yeah. When you've got Robinhood, you've got Coinbase going into traditional. You've got like all these guys that are building these super apps, and it's whether it's crypto or whatever. And so I just really hope the adoption of blockchain just increases in the way it's going and gets ingrained in the financial services system, because we finally have something that resembles a better product than what the old was. I think there was a speculation of that last cycle. Now it's actually operational. And I think you're going to see an explosion in terms of like traditional products coming into the crypto world.
Gary, well, what's your wish for 2026?
That's a tough one. Look, we want peace in the world. If we get a peace dividend, that would be fantastic. And that needs to be solved Ukraine in a fair way. It means China steps down and doesn't feel like it's going to have to do something to show everyone it's a big guy on the street. So as I said, I think if we think about it, it's west to east in a peaceful way.
Beautiful. All right, gentlemen. Well, thank you both very much for your time. I guess I'm paying for the beers on Monday night in Abu Dhabi, so forgive me for that. Have a great one, and thank you everybody for dialing in, and we will reconvene in 2026. Thanks very much, gentlemen. Take care.
Appreciate it. Thanks, guys.
Thanks, Gary.
Okay. See you
Monday.
Yeah. Yeah.